Good afternoon, welcome to Market Wrap number 201. Stuart Williamson here at the helm. This week we're going to look at interest rates, what's occurring and what does it mean to us as investors and as expatriates. Basically the headlines have been in the papers this week. Bailey signals UK on track for rate cuts as the US grapples with stubborn inflation. Basically inflation was at 3.2% this month, which was slightly higher than the 3.1% that was expected. However, Andrew Bailey, the Governor of the Bank of England, has come out and said he doesn't perceive that to be an issue in lowering interest rates and believes that interest rates should fall by 3 different cuts this year. So at the moment we're on 4.5%, he's expecting 3.75% by the year end. That's great for property buyers, because the market sentiment out there is very positive and that's looking good. Is it realistic? It would appear that the US inflation is being a lot more stubborn than UK inflation, although the IMF has said that the US will double its GDP growth this year compared to Europe or the UK. So there's a number of different factors out there that are affecting what's going on. As far as comments on what other people are saying, basically you have the market saying that, I'll give you some quotes just to be exact. A gentleman called Adegbembo from Jefferies, the economists, expects the first rate cut in August, saying they expect the MPC to keep rates on hold in May at 5.25%, but they're still on board with the 75 basis point cuts by the beginning of next year. However, if you look at the Institute of Directors, a gentleman called Roger Barker, he says inflation is on line to be at 2%, which is the Bank of England's target, and we expect interest rate cuts not to be complete until next year. So everyone's still saying that interest rates will definitely fall. It's just a case of when will it occur. And why is that important? Well, if you've got a 4.5% interest rate at the moment and we're coming down to 3.75%, it means in the offshore world we'll be looking at probably just around 5% as an ongoing rate on a floating basis. Fixed rates will be different, which is very good, because if your average yield is 6% plus, which is what we aim to get at APW, then you'd be well on your way to making money. And secondly, if you look at rental yields are currently going up by between 7 and 13% across the country. That will mean that over 3 years, your rental yields will go up by over 20%. So even though you're just breaking even or even underwater at the moment if you buy property, you're still going to see that soon become a success situation. So that's why it's important that rental yields are kept up, and it's, well, from an investment perspective that is, and why it's important that the interest rates are brought down. Now the problem we have is that there are a lot of factors out there that could affect that. You've got, very simply, if you look at the geographic world around us, we've got the Ukraine war. That could go seriously wrong for either side, and that could lead to escalation or capitulation. That will affect what's going on. You've got oil prices. Oil prices have gone up by nearly 20%, I understand, over the last 4 months. So both of those can affect inflation and spike it again. The FTSE had its worst day for 10 years this week. It fell by 2%. That was on the back of what's happening in Israel and with Iran. And that can really affect inflation, because that will affect oil prices again. That affects positive sentiment. So that's another reason why interest rates might not be coming down as quickly as the Bank of England is saying. But they were criticised 2 years ago for not putting rates up quick enough and getting rid of inflation. Now people are saying perhaps they're putting them down too quickly. So really, you can't really get it right, I think, in any of these things. What always happens is the market anticipates what's going on and then second guesses it. So if you're going to pull rates down, they'll be saying, oh, you shouldn't do that. And that is something we've always had in property. What does it mean to us? At the moment at APW, we are going through one of the busiest times we've had for a number of years, be it buy to let, build to rent, HMOs, houses of multiple occupancy, any of those sort of things. They are selling very quickly. We've done seminars this week in Hong Kong and Singapore, and the interest in those areas has been very strong, and we have managed to sell a lot of property. Most of the properties we're doing when it comes to buy to let or build to rent are in the Midlands and North, because they have the highest rental yields with the lowest prices. HMOs are looking up into Scotland, places like Nottingham, and Manchester, but they're all very vibrant, and clients are achieving their goals, wherever they may be, by using properties. And the mortgages we're getting are easy to get, they're not difficult. Yes, people do perceive them as being a little bit pricey at the moment, but compared to what? When I bought my first house, interest rates went up to 14%, but we still survived. The world didn't cave in. So what does it mean to us, as I said, as far as investors and buyers of investment property? It's a positive market sentiment. People are out there seeing that interest rates should go down, and all other things being equal, it's a good time to be investing in UK property. So interest rates will fall. Andrew Bailey is saying that. We're doing better than the US, not as good perhaps as France and Germany with their inflation figures, but the overall UK economy is recovering. So it's a good buying opportunity if you look at the right place and do your research. So that's it for this week. Thank you for watching. Do like, subscribe, share. Look at some of our other videos if you get an opportunity. We're there to help educate and help people make buying decisions. Thanks very much.